At 94, Warren Buffett shared a quiet revelation that completely reshaped how I think about retirement investing. Since turning 70, the Oracle of Omaha has focused exclusively on three particular types of assets. And here's the twist. None of them match what Wall Street constantly tells you to buy. Forget the classic 60-40 portfolio. Forget target date funds. Forget age-based formulas and rebalancing charts. At 70, Buffett tossed out decades of conventional retirement advice. What he did instead could radically change the way you approach your financial future. This isn't just any investor we're talking about. This is Warren Buffett, someone who lived through 15 recessions, survived the Great Depression as a child, watched entire empires crumble and rise, and experienced more market cycles than anyone alive today. By 70, he had already amassed one of the largest fortunes in U.S. history, exceeding $30 billion. Yet that's when he decided to pivot completely. Why would someone who had already mastered the game completely overhaul his strategy? Because Buffett realized something most investors, especially after 40, only understand too late. After 70, wealth isn't about chasing growth. It's about protecting what you have, maintaining dignity, and building a legacy that extends beyond your lifetime. It's about sleeping peacefully instead of obsessively checking your portfolio each morning. Today, I'm going to walk you through Buffett's three assets, why he picked them, and exactly how you can start implementing the same approach today, no matter your age or net worth. First asset, cash-flowing monopolies, not just shares. People assume Buffett just buys stocks. That's wrong. After 70, he shifted from purchasing shares to acquiring entire cash-generating businesses. He wasn't interested in owning a slice of a company. He wanted the whole operation, particularly businesses that people rely on regardless of economic conditions. Look at his major moves since 2000. BNSF Railway, purchased for $26.5 billion, remains the largest acquisition in Berkshire Hathaway's history. This isn't a trendy tech startup. It's a railroad hauling nearly half of America's freight. Recession or boom, Democrat or Republican administration, high or low interest rates, the trains keep moving, producing billions in cash every year. Then there's Berkshire Hathaway Energy, which serves millions across several states. Or Precision Cast Parts, making vital components for aircraft engines. These aren't speculative investments. They're reliable income-generating machines, consistently producing predictable cash. I met a retired engineer from Detroit who applied this principle. Instead of keeping all his savings in mutual funds, he bought a modest apartment building. Not glamorous, but essential. It generates $3,200 per month in rental income, no matter the stock market's mood. He sleeps well because he owns something real and necessary. Buffett understood the same truth. Stock market gains are fleeting, but cash flow pays bills, maintains dignity, and ensures options when unexpected costs arise. The lesson: control and necessity. After 70, Buffett focused on businesses serving fundamental needs: transportation, energy, housing. These sectors don't vanish or get disrupted overnight. For you, think beyond traditional stocks. Explore dividend aristocrats, essential real estate, or even side businesses that generate steady income. The question isn't, will I get rich fast? The question is, will I have reliable cash when I can't work anymore? Second asset, government-backed insurance float, the quiet gold mine. This next category sounds boring, but it's brilliant. Buffett's obsession after 70 wasn't chasing high yields. It was float. In simple terms, this means being paid to hold other people's money, which he then invests while waiting to pay claims. Through Berkshire's insurance businesses, policyholders send premiums up front. Buffett invests that cash immediately, earning returns on money technically belonging to others. Most claims aren't paid for years or decades, while the money grows nonstop. You might think this only works for billionaires, but the principle applies to everyone. Prioritize guaranteed, predictable returns over chasing speculative gains. Treasury bonds, for instance, protect against inflation, pay over 5%, and carry zero market risk. CD ladders work similarly, spreading your money across different maturities to ensure steady, predictable income. I know a retired teacher in Ohio who mirrored Buffett's float with a fixed annuity. She invested $200,000 from her 403b and now receives $1,100 every month for life. No market volatility, no stress. Certain life insurance policies can also create tax-advantaged cash values. The takeaway isn't the product, it's the mindset. Base hits, not home runs. Steady, reliable returns that protect your peace of mind. Third asset, reputation capital, the ultimate moat. Buffett's third asset isn't listed in any portfolio. It doesn't appear on balance sheets and can't be purchased outright. Yet it may be his most valuable asset, his reputation. Every shareholder letter, interview, or public insight Buffett shares isn't just generosity or ego. It's an investment that compounds faster than money. Trust. By building a reputation for integrity and wisdom, Buffett opens doors that money alone can't buy. CEOs call him in crises. Companies seek capital from him. Investors hang on his words during turmoil. His reputation generates opportunities that remain closed to everyone else, regardless of wealth. A financial advisor I know in Phoenix grasped this early. Instead of chasing clients, he started a weekly newsletter offering practical financial advice. No sales pitches, just value. Over 15 years, it grew to 8,000 subscribers, and clients now come to him. His reputation became his most powerful asset. Reputation capital extends beyond business. It's about becoming the person others seek for wisdom, mentorship, and guidance. Maybe you're an experienced engineer mentoring juniors, a manager sharing lessons at conferences, or a tradesperson teaching your craft. Reputation is leverage. It generates income, opens doors, and creates opportunities independent of your ability to work physically. The beauty? It's never too late to build. Whether 45 or 65, your experience and knowledge are assets others need. Start sharing it today. Why these three assets matter after 70. Most people miss this. Buffett's strategy isn't about the assets themselves. It's about what they protect: time, dignity, choice, and legacy. In your 30s or 40s, you invest for growth. You have decades to recover from mistakes. Your human capital is your largest asset. After 70, time is scarce. Every dollar represents freedom. Freedom from worry, freedom to choose, freedom to support causes you care about. Look at Buffett's three assets. Railroads and utilities generate cash flow for generations. Insurance float protects families and businesses. Reputation influences investors and leaders long after he's gone. This isn't retirement planning. It's dynasty thinking. Each asset serves multiple purposes: income, legacy, meaning. My grandfather instinctively followed similar principles. He bought a duplex, lived in one side, rented the other, saved in bonds, built a trustworthy reputation. By 89, his duplex still generated income, his bonds provided steady cash, and his reputation opened opportunities for descendants. The lesson: you don't need to be Buffett. Think beyond accumulation. Build assets that serve you, your family, and your community. Maybe you're thinking, I'm not Buffett. I can't buy railroads. That's fine. Principles apply regardless of scale. Cash flow assets, dividend aristocrats, REITs, or small businesses serving essential needs. Even a laundromat can generate $2,000 per month after expenses. Government-backed securities. Series 1 bonds, treasury ladders, or fixed annuities create safe, predictable income. Boring, yes, but reliable. Reputation. Share expertise, mentor, write, consult. It compounds over time, opens doors, and generates opportunities. The warning: why Wall Street dislikes this. Buffett's post-70 approach threatens the financial industry. No trades, no rebalancing, no constant fees. Brokers profit from keeping you anxious, moving money, chasing trends. Buffett ignores the noise. Buy quality, hold forever, collect cash, sleep well. Most people in retirement don't need market optimization. They need preservation. Base hits, not home runs. Outlasting the market matters more than beating it. Buffett's shift after 70, From accumulation to preservation, from growth to cash flow, from hoping to knowing, cash flow monopolies, government-backed securities, and reputation capital aren't just assets. They're pillars supporting dignity, choice, and purpose. You can start today. Build cash flow, secure guaranteed returns, invest in your reputation. The best time to plant a tree was 20 years ago. The second best time is now. Your future self and family will thank you. On a scale of 1 to 10, how useful was this breakdown of Buffett's post-70 strategy? Drop your rating in the comments. I read every one and appreciate your feedback.